Hey there, folks. Welcome back to the channel. Today is going to be a Sunday edition of options mistakes and things you can do to not have the mistakes repeat in the future. So, to start off, it finally happened. My strategy of collecting premiums on a stock finally backfired and it worked against me this past Friday, which I kind of knew was going to happen, but I didn't think it would happen this soon. But in a way, I'm glad it did because it's better to learn things earlier than later, and this could have been a lot worse. So I like to be fully transparent on this channel, and I don't like to mislead my audience and make them think that I am just successful all the time because I'm definitely not. But those of you following me know that I put out a video a couple weeks ago about earning passive income with doing covered calls on stocks you already own. That's what a covered call is, right? So this strategy worked out for me for 2 weeks in a row. It worked out great. And I was averaging $1,000 a week on this. But what happened? I got a little greedy and it worked against me. So if any of you have been following Blackstone stock, like the rest of the market, it's been plummeting. But Friday, we had a very random upshoot in the market, which for me, I really have gotten to the point that this market's not making any sense at all because based on the news that came out Friday, I did not expect the market to be up. Definitely not up as high as it was. I mean, the Dow closed up 800 points. And when I got this premium that I got for the third week in a row, I knew I was taking a little bit of a chance because what I was doing, if you can see the screen here in front of me, what you're looking at is what I collected in premium over the last 3 weeks. So I rolled this down basically, which that's kind of what you're supposed to do when you do these. The stock was close to $120 3 weeks ago, but it's been consistently dropping. So as it drops to collect a significant premium, you want to roll it down. So I opened one, I sold to open on June 10th at $120 strike price, collecting a really nice premium that I kept. Super exciting. And then the next week, June 17th, because the stock had dropped so much, I collected a premium at $100 strike price. That was $723, but this could have been higher. And this was mistake number one. And I'm going to show you in the next section of this video. I'm going to actually go and look at some mock trades because now it's to the point, I'm a forward looking person. I look at, all right, how do I fix this? This isn't too bad. I mean, I basically came out even. I'm slightly down instead of being up. But you look at this, the first week I collected 1,073, second week I collected 723.34, which like I said could have been higher. The third week was down to 583.34, which on the day I got it was on a Wednesday. That was the most premium I could coax out of it at the price it was at the time. But because of the movement Friday, which I didn't foresee coming at all, I figured with the CPI number that came out that the market would at least stay flat, if not drop. But for whatever reason, it was insanely up, which it's to the point the market just makes no sense. So even when you're making conservative moves, you have to be extra careful, even just doing that. But I opened it for the third week. I opened it at a $94 strike price, sold to open. I collected 583. And as you can see here, the cost here, because you see zero and zero, the first 2 weeks for the third week, I had this lofty $2,594 cost because that's what it costs to scramble and close the position out so that I didn't risk losing the shares. Because if I stayed in this, remember, you always keep the premium, but then if it works against you and suddenly that stock shoots up past the strike price, you're going to end up being called out of those shares. And obviously, with this amount of optionable stock shares, I definitely don't want to get called out of it. So it worked against me, but I can recover. But it's a bit discouraging because, when you're putting all this effort in, and you start to make some income doing this, and then just like that, in the matter of a day, the market randomly decides to go up when it's been bearish. And then this works against you and it just wipes out everything you've done for the last 3 weeks. It's kind of discouraging because it's like, you did well on one hand, but then it wiped it out on the other hand. And it's like, well, back to the drawing board. Guess, got to work longer. So, but I think that each thing that happens is a lesson to be taken. And this is something that me and my audience, we can kind of all follow along the journey and learn together. So I think that in the wake of this happening, in light of this, I think that I've come up with some ways to mitigate this and not, I mean, I can't guarantee preventing this again, but definitely softening the impact of one of these shooting up, because I knew this was going to happen. I knew at some point or another. This is like very common, like human psychology. Something works out for you well, you keep kind of pressing your luck until boom, it works against you. But I knew at some point when you're doing these, you're always going to risk, especially when you're trying to collect the most premium and you're buying as close as possible to where the stock's trading at. You're going to end up close enough where it's like you have the wings and you're too close to the sun and then they melt. But with this, the closer you are to that strike price, the more risk there is, and the more risk of the stock moving up past that strike price to where you have to make a quick decision. And by open of market Friday, it was already above this $94 strike price for this June 24th call. And I knew basically the market trades for 6.5 hours. So I had 6.5 hours to make something happen. And I figured when the stock opened, because what we've been seeing over the last couple months, even when the market opens in a bullish direction, it's been dropping. So I said, all right, let me kind of watch it and see what it's going to do. But it kept going up. So by watching and waiting, it made it even worse instead of just getting out of it right then. But in some of these cases, you really, you don't know. I mean, you can sit there and look at candles and look at technical analysis and all of that. I'm not fully sold on that. I'm more of a fundamental guy. And, I'm not fully sold on the technical analysis, but let's look at, so in the $723 premium that I collected here, this could have been $300 higher. I actually got ripped off on this one. And this is because I placed a market order instead of a limit order. And I realized this after the fact, and it was stupid on my part because I should have, I'm using a newer, I haven't traded options on E-Trade until these last 3 weeks. So it's a different platform for me, even though I've been using E-Trade for years to trade stocks. I've been using Ameritrade to trade options. So being on E-Trade, it's a bit newer, but I mean, it's basic stuff, bid and ask. At the bid, you're going to get like the bottom price, which when you're selling, that's what it's going to fill you at unless you specify. It's going to fill you at the bid. Whereas if you're buying, it's going to fill you at the ask. So now let's go to some mock trades here. Now I've obviously looking because I'm eager to reverse this crap. So I've been looking over the weekend here to see, all right, what could I do to open another one and hopefully not risk getting called out of it. So there's a couple of things. So the first thing you want to master is not getting ripped off by selling it and getting the bid price when you sell to open. So the first thing, just hypothetically here, if I was to pick $100, I wouldn't do this and I would not recommend this at all. Of course, none of these are ever recommendations, what I discuss on here. But just $100, just for the case of this example, this would be a juicy premium for a week. But see, with E-Trade, it defaults to market order. And what is the market order at? It's at the bid price. But if you look carefully, the last price was 205. So if we were in a live trading market right now, which of course we're not because this is a Sunday afternoon, we would want to get filled at the midpoint between the bid and the ask. So instead of this, even though 1488 looks nice, most people would just take this, you're actually leaving money on the table. You want to put a limit order on this at least 205 where it was last. And you see, let me see here. You know what? It's sell to open, not buy to open. So let me start this example over. Okay, so sell to open, which is what we're doing. You see the premium is 13.18.33, and that's because the sell order is going to fill as close to the bid price. It's actually going to default to the bid price, which is $1.89. But you see the last price was $2.05, which is the middle point between the bid and the ask. So this 13.18, you're actually leaving money on the table, like I was saying a minute ago. So what you want to do is fill this at the limit price of 205, which is 14.30. And then if it's moving up rapidly and you have a lot of volatility, say it's going up closer to the ask price, and then say that the ask price is even higher at this point, then you could go to 210 for your limit. And then you see you've increased this already almost a couple $100, just like that. And then say 215, if it's moving even higher, now you're at 1,500. So what happened in that example of $723? I probably left $300 of premium on the table by getting filled at the bid price. Now, the other thing you can do, instead of doing a covered call, you can just do a spread trade, which is probably what I should have done instead of doing the covered call. So to do that, you would add an option leg, you would add a buy to open, and you would probably go $1 higher. And then at the market, see, you would collect a slight premium on this, because what you're doing, and this would have worked brilliantly in what happened Friday when the stock shot straight up. Remember, when you're buying to open a call option, you're bullish on the stock. So you're thinking that by the time this expires, and of course you're going to get out of it before expiration, the stock is going to be higher. So this premium that you bought is going to move up higher, and that's going to benefit you, because when you sell it, you're going to sell higher than you bought. Whereas when you're selling, that premium you collected, remember, you keep that no matter what, but the value of that option is going to decline at that point. So then you're actually hedging yourself by doing the spread, because you're selling to open and collecting a premium at a lower strike. And remember, because this can get confusing, actually the first time I did one of these, I screwed it up. And the trade was supposed to be, I was supposed to end up netting a premium, but I think it ended up being a net debit, because I thought, well, wait, I want to sell at the higher strike and buy at the lower strike. So if you don't know what you're doing on this, you can easily screw this up. But the good thing with this spread, you're not going to come out too bad. You may just have a slight loss, but it's not going to require a lot of upfront capital on your part, because you're basically covering yourself by doing a sell to open and then a buy to open. You're essentially covering yourself, instead of, if you were just selling just the naked call without covering it or without doing any kind of a spread, you would have to come up with that money. And then if that thing moves against you really fast, you're going to lose that money fast. But in a spread trade, you're really covering yourself. So I think in hindsight, this would have been the better option. No pun intended, but I would have been covered if this had moved up, because by Friday, if I go back to that trade, let's see. Oh, it's not going to show. Yeah, it's not going to show the premium, and I'm not going to pull that up in this video. But basically, I got it for, it was like 90 cents per contract, and then by the end of the day, it had moved up to like 350 per contract. So if I had this buy to open and it did that, basically it more than 4x'd. So in that situation, that, you know what, let's see if I'm doing good on time here. Let's go to Ameritrade. Where is it? I want to back test this for this video. Let me see. Okay, so like I said, I typically use Ameritrade on these. I'm actually looking at a juicy trade on Mercado Libre. This was the last one I back tested. This is off subject, but if you had sold puts against Mercado Libre in January, you would have been insanely rich, because you would have made like 30,000 in premium. Let me just, since I'm on that, let me just go to that really quick. So going to June 24th, close of market. Wait a minute, that's not what I want to do. Go back to January, go back to like January 5th. And see, me, like a lot of other people, I wasn't really as forward looking as I should have been. I should have realized the way things were going at the end of 2021. And this was a big blunder that I'm going to really think about and talk about for a while. I knew the Fed was going to start raising interest rates, but for whatever reason, I just didn't think it would happen as soon as it did. But once that Fed report came out in January of this year, the market just did this. And a lot of my call options should have been put options, and that would have completely reversed a lot of things. So for this Mercado Libre example, and I know I'm kind of jumping all over the place here, but this would have produced a $13,000 gain if you had sold a call. I'm sorry, not a put. If you sold the call, is that right? Sell the call January 5th. That's what this would have been because the stock dropped so much. But anyway, let's go to Blackstone now. Let's back test this trade that I'm talking about here. So let's clear this out, and let's move my face down here to the middle to emphasize midpoint. Remember, not bid or ask, but the mid, right? So let's go to June. Oh, you know what? I haven't refreshed this since, let me see. Oh, come on. June 24th. Let me see. This hasn't been refreshed. Come on. Well, let me see if I can use something else here. It's buffering. Wow, it's buffering. Okay, June 24th. Come on. Bear with me here. I just switched over to the virtual account. This is Play Money. That's why you see $100,000. I would never show that in real money on this channel. Okay, so it's not going to give me June 24th. So let me go to the 17th. If I can, that's already gone. Let's see here, June 24th at a $95. And I've already covered everything I wanted to cover in this video. This is basically just bonus content. So if you're interested, just stick with me here. So $94. And see, this had moved up by the 22nd, or was this the 20th? No, the 20th, the market was closed. Let's go to the 20, we can do the 21st. I'm not gonna open and close this during this video. So the 21st, we're looking at the $24. And let's go here. We're back testing if we bought this at 90 cents. 10 contracts. And then profit and loss date, we're going to go a day out because that's all we can do. This would have lost 275 at this point. But let's see if we had gone. Wait a second. Sell. So we would have made 275. But then if we bought at a lower price, let's go here. We're just going to do the ask just because it's easier. So we sold and we bought. Let me see if I go back to, I want to go back a week just so we have some more time here. So trade date, June 15th. Profit and loss date, the 21st. Let's go to the 22nd here and here. NA, because I need to set this to this. Close this out here, something's wrong. Why is this showing 0? Not understanding this. Uh, let's switch back to buy. I mean, basically, I'm trying to illustrate what I showed in this E-Trade example, but it doesn't seem to be cooperating. So let me just go back to E-Trade. Basically, you get the idea. So you collect a slight premium if you make this trade. Now we're fast forwarding back to July 1st. You make a slight premium if the stock goes up, which I think it's going to, because if you look at the indicators right now, it's back on a bearish trend. And the moving average is about to cross the long term, the midterm and the long term moving average are converging, which is signals a bullish direction. So I do expect this to go up. So I would, this week, instead of just doing a covered call, I would do a spread trade like this. Collect a slight premium, and then if it goes up, basically on the buy of the call option, I'm buying it, and it goes up, I would sell to close at the higher price, buy back to open to reverse the other side, and then I would net, probably a decent profit if it goes up, like say $5 to $10 a share. That would be a decent profit. If it drops, then I would just have to get out of it and just eat it at that point. But it wouldn't be as bad because of the spread. Hopefully that was understandable. Hopefully I explained that as well as I could. I'm not a complete options expert. I'm still learning some stuff myself, but hopefully we can all follow along this journey and learn together. If you enjoyed that, please remember to like, comment, and subscribe. And thanks so much for watching.